Welcome back to another BLS Jobs Report. Oh, snap. Here we go. We are 2 minutes and 30 seconds away. This is a very big deal because the market is specifically now selling off, not because of inflationary concerns, but because of recessionary concerns. That's right. So, in other words, the market is convinced that inflation may have peaked in June of 2022. But now the concern is that the Federal Reserve is going to keep rates so high at 5% for so long that they're absolutely going to crush this economy. Now, of course, when we look at the jobs data we've been getting so far, everything's been peachy. But then again, jobs data is super lagging. We've had some strong warn notices at the beginning of the year, suggesting we should start seeing lower job gains either now for the April report, which comes out right now, or in May, which that report comes out in June. We should start seeing some of those warn notices actually show up in the lagging data like the jobs report. But the jobs report is really important because if we end up getting a beat like we did on the ADP report a few days ago, we could be in this bizarro Goldilocks insanity land where all of a sudden the economy's not trending into a recession because if people get fired and get another job, then maybe they can spend us not into a recession. And we could actually potentially have more time to beat inflation, which is exactly what Jerome Powell wants. Jerome Powell wants time to beat inflation. Now, the bond market is convinced we're going to get rate cuts this year. Of course, anytime I even suggest that the bond market suggests we're going to get rate cuts this year, people think I'm saying, oh, we're definitely going to get rate cuts this year. That's not what I'm saying. Jerome Powell made it very clear that we're not going to get rate cuts until we see services x housing inflation fall. And he believes that could happen within 2 months. Now, if we do get that inflation falling in services x housing within the next 2 months, we get those data releases and we get some good positive indicators, hey, then maybe we start talking about cuts. But until then, now we got to focus on jobs. Now, the ADP data came out 2 days ago. 2 days ago, oh my lordy, we had some beautiful data on the ADP report. In other words, rather than getting 150,000 jobs, we got 296,000 jobs. Now we're expecting 185,000 jobs for non-farm payroll. Unemployment rate at 3.6 comes out in about the next 10 seconds. Buckle up, folks, and do remember that you can now make more money and get SH&IT done faster with the new rebranded AI course and Elite Hustlers course linked down below. Coupon expires tonight. Here it is, $253, another strong report. Wow. Ooh, average hourly earnings, not so great, ticking up a little bit from 4.2 to 4.4. You've got a change in private payrolls coming in at 230 versus the 160 expectation. Ooh, average hourly earnings month over month at 0.5. Not so ideal. We're getting that push up there in that wage inflation segment again. See, that's exactly what you actually don't want, is you don't want to see that wage inflation kind of ticking up, because wage inflation is directly related to services x housing. Services x housing inflation is driven by wage inflation. Well, wage inflation just ticked up. We were at 0.3 last time on the month over month. We were expecting 0.3. We got 0.5. Not great. We were looking at 4.2 year over year. We got 4.4. Now let's look at the actual BLS report. While I pull up that BLS report, because I didn't get to finish my thought, the point is, this is a freaking awesome course to help you build more money and make more money. And we're going to use AI to increase your productivity. It's not just giving you like prompt. Nobody wants to be a prompter, okay? Nobody wants to sit there and get a list of tools. What we want are, how do we actually make more money with this stuff? That's what we want. That's what we care about. And that's exactly what we're going to be talking about in that program. So check that out. The price will be going up tonight. Okay, so BLS labor report. Let's see here. So I'm pulling up the actual report right now. Here we go. We've got it, May 5. Okay, here's the actual report. So let's see what we've got here. Unemployment rate unchanged at 3.4. Employment continued to trend up in professional and business services, healthcare, leisure, hospitality, social assistance. Both the unemployment rate and the number of unemployed persons changed little in April. That's fine. It was really the pay. I want to see why that pay moved up so much. The number of persons jobless 5 weeks decreased. See, this is not recessionary. The jobless now people jobless 5 weeks decreased. by almost 500,000 here, 406,000. That's jobless for less than 5 weeks. Now, keep in mind, one of the reasons you see this is partly because there are so many jobs still available, and so there's this idea that, okay, well, as long as people can keep getting jobs, maybe no recession. We did just get our revisions. Oh, wow, that is so. What weird freaking data is this? The prior jobs release was 236,000. They just revised that down to 165,000. And the private payrolls in the last one was 189, and they just revised that down to 243, and they revised up the prior year-over-year inflation wage read from 4.2 to 4.3. Really mixed report, still strong, but what we just beat by, they basically took away in the revision. Which is really weird because it basically tells you, okay, well, we didn't really create any more jobs than expectations here. I mean, if we do the actual math, we're looking at a beat here. 253 was the beat, much in line with the ADP report. 253 was the beat. We beat by 68,000 jobs, but that might be fine, but they just removed 236 minus 165. They just removed 60 or 71,000 jobs. So you basically have now an at expectation employment report when you consider the revisions and the takeaways they did. But the big concern is that that wage growth segment, which is not fantastic, because as much as we want inflation to go away, we don't want any indicators suggesting that, hey, the Fed needs to stay higher for longer. And this is a little bit that, while not being as rosy of an employment report as initially thought because of those revisions. So let's see. Employment continued to trend up in professional and business services. And this is also wild. How are professional business services still moving up? Now at 43,000 with an average monthly gain at 25,000. Employment in healthcare increased 40,000 in April compared with the average monthly gain of 47,000. Leisure and hospitality up 31,000, also above trend. Social assistance added 25,000, in line with the 21. Employment and financial activities increased 23K, with insurance carriers and related activities up 15K and real estate up 9K. Wow. Employment and financial activities changed little in the first 3 months. Okay. I mean, this is not a weak report at all. And now we do tend to get fluctuations in these average hourly earnings, but let me see if I can figure out why. Okay, so here's what is this? Here's that 0.5% on the month over month. Over the past 12 months, they've increased an average of 4.4%. So we're still at that average sort of, although 0.5% annualizes to 6% inflation, which is too much. In April, average hourly earnings in the private sector, production, non-supervisory, rose 0.4%, fine. Okay, what about the work week? Wow, interesting. The work week was unchanged. An unchanged work week, overtime consistent, production, non-supervisory edged down a little bit. Okay, and then we got our revisions. Wow, this is very interesting. Then you've also got the labor force participation rate sitting at 62.6. Let's see here. 62.6 was the expectation. Let me get one of the tables here. This is an interesting report to really break down, though, because even though it looks like we beat, they just revised down the job gains for last month. So really, we're at expectations for kind of both months. So you don't really have a hot jobs report like the ADP report suggested, but you do have slightly hotter inflation, which isn't great because to some extent that's a little bit of the worst of both. Anyway, so let's look at the household data. What did the household data say? So household, let's see here. Civilian, let's see here. Labor force. Interesting. The civilian force on the household survey actually fell 43,000 jobs. Now, that is interesting. So, and also not great. That's a little bit more of a recessionary red flag. So what does that mean? So there are two surveys, right? There's the payrolls, the establishment survey. That's the headline we always read. And then there's the household survey. So how can the payroll survey come in at a read of 253,000, when the household survey comes in at negative 43,000, well, that is a potential early indicator of finally the employment report starting to roll over. So here's how this works. So write this down. The first thing that you want to write down is existing course members get this AI upgrade totally for free if you're in that Elite Hustlers group. And if you're not, you'll want to lock in that price today before it goes up tonight, 11:59. You're going to love the productivity segments. It's all about how you can actually make more money using these new AI options that we have. Anyway, the number one, payrolls data. So payrolls is, think about it as the BLS calling businesses. How many payrolls you got? Okay, well, this double counts people or potentially triple counts people. That's because they're calling businesses and asking how many payrolls there are. Well, if somebody works at two businesses, then businesses answer twice, right? Now, if we look at the household survey, the BLS calls people to ask if they have a job. And this is very fascinating. The civilian labor force, well, hold on a second here. Maybe I read the wrong number. Hold on a second. Civilian labor force. The civilian labor force fell 43,000. Wait, no. Yep, I read that wrong. Sorry about that. The labor force fell 43,000. Okay. The household survey itself actually grew by 139,000. Okay, all right. So the household survey is actually still, we've got growth. No, actually, both sides of the data are still strong there. Both the payrolls data at 253,000, despite that negative revision for last month, it's still strong though, and the households data here. Sorry, misread that. But now you can see where the data is too, so it's good for you to see that. Okay, so both sides of that unemployment report strong. We've got, here we go, job leavers at negative 55,000. So less of that, and that really contributes to a wage spiral, is when you have people leaving, they tend to get twice the expected pay increase that you would if you stayed at your job year over year. So it's not as easy as saying this is a good report or bad report. I would call this a very mixed report. I guess if I were to give all of this report a bottom line, so what would my bottom line look like? My bottom line would be this. This is not recessionary. It's not a recessionary report. It was expected to potentially be a recessionary report. It's also not a boom report, thanks to the negative revision. However, it also indicates we still have some work to do on inflation, given that wages are up 0.5% month over month, but this can be volatile in the employment report. Now, worth knowing that CPI comes out in just, 5 days? So CPI in 5 days. So mark your calendar for May 10th, and then mark your calendar for June 13th. May 10th, June 13th, you'll want to be there for those CPI days. So I would call this report mixed. Let me see what other data we have here. Let's also see what CNBC has to say here.
All you need is one strong jobs number, one inflation report to get the Fed funds back to a 25. But
it's not.
But no, I know, because it's not. I don't think the jobs numbers shouldn't do it, but the inflation number could do it.
Yeah, next week.
Yeah. In other words, this is not too strong to where you have to go back to hiking, thanks to those revisions.
That's an important concept, because let's remember the Fed is looking for a 4.6% unemployment rate by the end of the year. We just went a tick away from that idea. So part of their whole construct is this rise in unemployment, eases up, loosens up the economy, takes some of the inflationary pressure away, and you have a declining inflation rate. Well, to the extent that wages may be driving inflation, certainly perhaps on the service side, which is Powell's concern, you're not getting that. I have a hard time, Joe, understanding the pricing of the Fed funds market. For example, the 3-month Treasury bill is trading at 520 and change, or 527, but the 3-month Fed funds future, let's see, what would that be? August or so, is at 499. I don't understand what the gap is. Maybe Rick does.
Or Jason.
Because it's a log jam. because every month's predicated on the value of the preceding month having its effect on the new month. So that log jam makes it different than the standalone T-bill auction.
All right. Not what was well, go ahead.
Love that guy.
That's what what was oil trying to tell us at 69, maybe up above 70 again, but I mean, it doesn't that tell us that a lot of the Fed's work is already done in terms of demand and global growth or not?
Look, the signs are pointing in different directions, and that's the thing we've been struggling with for the last year. There's been some economic slowdown. The job market just doesn't seem to be budging. Although I would say sometimes these things move all of a sudden. So we do need to
gradually, then all of a sudden. Yeah.
Exactly.
You know, I do want to talk about oil quickly because oil's been hitting the oversold level here for quite a while. And anytime it does, it tends to be a bullish bet. Look at how weak oil has been. I mean, it's been weaker than this Fibonacci, right? So this fib over here is way off. I mean, we could replace this on USO right now, which we may as well do because it just looks like crap. So let's draw a new fib since it's been a while since we've been on this chart. And let's align that quickly. What do we got here? We got 92.20 on one side and 61.81. 61.81, 92.20. All right, fibs cleaned up. Oh, no, apparently not. 57.83 is actually a lot. 57.83. There we go. Okay, but look at the relative strength index over here. I mean, you fell below. You almost hit 30 again here on USO. It looks like you fell down to about 31. And the last time we got this low on oil, it was actually bullish to bet on oil. But then again, we did get the boost of the Saudi and OPEC production cuts right here. So a little bit unfair. But usually when we fall this low, I mean, look, it's you get a rally, you get a rally, and here we are again at a low RSI. So wouldn't be surprising to see a little bit of a pickup again in oil. But for right now, these oil numbers are great for helping us get CPI down, which is fantastic. As far as this employment report, I mean, I want to see what the suits are saying about it here. But to me, again, the bottom line is it's not a recessionary report, but it is one that is going to reiterate how important inflation still is. So let's say what we've got here. Employment data was stronger than expected, suggesting more labor market tightening. However, the headline beat was more than offset, well, slightly more than offset, by the downward revisions from the prior 2 months. So it's a net dovish development. All right, fine. But the unemployment rate matched cyclical lows thanks to a slight drop in the labor force, right? We saw the employment, civilian population decline. That was that 49,000 number I read you. And monthly pay gains were at 0.5%, well above expectations. Taken at face value, this suggests the labor market is tight enough to spur a more aggressive firming for what wages are being offered. So in other words, you still have such a tight labor market that businesses to some extent are still offering more money to get people employed. Should we take it at face value? Anecdotal data like the Beige Book suggests that pay pressure is moderating. I agree with that based on what we're seeing in earnings calls. And the Jolt suggests labor demand has slackened. Moreover, downward revisions are exactly when you tend to see turning points. Ooh, and that raises questions of how reliable the headline figures are. Ooh, okay, so that's a fancy way of saying that when the market starts turning, in other words, or maybe not necessarily the market, but when jobs data starts turning and numbers start getting bad, the reliability of your headline numbers is low. So you end up with more revisions in the subsequent months as it's easier to sort of perfect what the data really is. So in other words, it's so early into May right now, you know, this report was probably done a few days ago, that maybe we just don't have all the reliable data yet from April. Of course, everybody reiterates the idea that, hey, well, when is the government's data reliable? But it gets even, if you can imagine it, it gets even less reliable as you get closer to a potential recession or bottom in the economy. So that might be consistent with some of these large revisions that we're seeing here. So it's certainly not an overly hot report where we would expect the Federal Reserve to say, that's it, we got to raise rates immediately. But it is going to be a higher for longer style report. And I think, again, it just shifts the burden onto the CPI reports. So not horribly concerned, but it is something I'm paying attention to. All right, great. So what else we got here? Let's see. Looking at some of your comments here. Good time to buy SoFi. Man, SoFi got hit, huh? Yeah, SoFi is certainly on a discount right now. Open Door beat, although they're not up as much as I was expecting them to be up. They did beat. They're up about 6% right now. Steve here says this will be worse than 2008. Palantir is going to buy your mega yacht. What's Palantir at these days? I like Palantir. I think they're pretty cool, but I can't invest in them at the moment. I think they're a great company though. So they're at $7 right now. Why don't we try to do something about plain old greed and price gouging? How many CEOs are receiving $25 million in annual compensation? Well, Frank, so you would actually appreciate reading an article from The Economist, which actually dives directly into this idea of price gouging at corporations. It's an argument that Elizabeth Warren makes a lot on TV. She says that 40% of inflation is due to price gouging. The Economist did a study on that data, and they did not find it. Now, and they lean left, so they would be inclined to agree with the leftists who are saying that. So, and I'm not saying there certainly aren't companies who are doing price gouging, but some of their argument was prices have gone up. Like there was so much demand, prices across the board have gone up. So, strictly looking at CEO compensation, I'm not convinced is the correct metric to suggest that companies are price gouging or not. I mean, that's always been the case. The CEO has been paid a lot. Anyway, let's see here. Shop got rid of its fulfillment. Did they? What? No, they were talking about expanding their fulfillment business. They were just talking about that. I always expected that to be a very expensive part of their business. Yeah, I don't see where you're seeing that. Yesterday. Yeah, sells their business to Flexport. Wow. And Deliverr cut staff. Oh, wow, you're right. I totally missed that. I don't invest in Shopify, so I don't go so deep into Shopify. I saw they cut staff, but wow. That's actually really interesting because one of the big problems that I've had with Shopify, and one of the reasons I haven't invested in Shopify, was because I thought, why the hell would you get into fulfillment? That is like the most nasty kind of business to be in. It's extremely expensive. It's extremely challenging. And it's basically a race to the bottom. Wow, you're right. Flexport agreed to buy the logistics arm of Shopify and Deliverr. Wow. And Shopify is just taking an equity stake in Flexport. Very interesting. That's very, very good idea here. So good for Shopify. I'm glad they killed that because that was my biggest excuse for not wanting to invest in that company. I'll have to take another look at that. Maybe in the course member live stream. Remember, you get lifetime access still to the course member live streams and everything. If you join the featuring AI course where the AI products come out on June 1st, it's free for the existing members of the Elite Hustlers course, which is now the How to Make More Money and Get SH9T Done Faster course. You'll also have lifetime access to all those fundamental analysis lectures, whether it's on real estate analysis or stock analysis. We do that all in the course member live stream together. And you get the whole archive, too, of all the actual fundy analysis that we've gone deep on. But wow, really, really good observation there. Thank you for mentioning that. That was great. May sound anecdotal, but most hiring resources, recruits, hiring departments have been downsized or let go. So while the job number available seems high, the actual throughput to fill these jobs will not match. Yeah, that's a really interesting observation as well. Just the idea that, hey, if you have smaller hiring departments, it's going to take longer to actually hire people. Interesting observation. What is Becky saying? Hold on a sec.
Mario Gabelli. He is the chairman and CEO of Gamco Investors. And Mario, we get to see you here every year.
Mario,
know that you are.
What does Mario have to say about this jobs report?
It's not necessarily company fundamentals and not necessarily the big picture, but there's some really weird stuff happening in the big picture right now. And I can't imagine it's not factoring its way into how you think about things.
Clearly, one has to think about how the banks could break an old philosophy. What Buffett does, Becky, what he did was he gets his float. I pay him for my insurance, and then he doesn't have to pay me for 3 or 4 years. He takes that, so he borrowed. The other guys take my deposits and lend very long. Rule 101, it's a challenge. And then they had an accounting.
So insurance is better than banking because
I agree with
you
that.
can't get your money back.
Right.
The deposits are much
you got
stickier.
your insurance and it's been paid for, and you get the benefit of that down the road. So the second part of what Buffett does is patience. In other words, step back and look at the cycles, and he knows there are cycles. I mean, I started covering autos, farm equipment, conglomerates, and the media and entertainment. And during that period, the banks lost money on what they called oil tankers. And I said, why? Then in the 70s, they lost money with the banks. And then the real kahuna was in 1990 with the savings and loan. And they passed a rule called hold to maturity. And that's what the Fed should look at. How do we change that?
All right. We don't need an explanation on how scammy hold to maturity accounting is, where you basically say, all my losing assets, don't worry, I'm diamond handing those. I don't need to take any loss on those because I'm diamond handing them. But anyway, we're going to hop over soon to the course member live stream. We're going to be going through the Bill earnings, bill.com. I've had some of my personal stock exposure increased to bill.com. I actually initiated a position in it just about 3 weeks ago, 3 weeks ago, something like that. And the fundamentals look great then. It's up 14%. Haven't looked at the earnings yet, but obviously some excitement there for bill.com. So we'll dive into that. Open Door, as much as I absolutely hate and despise the company, it's actually a complete, in my opinion, bargain where it is right now. It's extremely inexpensive. If you look at the their balance sheet and how strong Q1 has been for housing, I think they're a little bit priced below book right now. Then again, I still hate the company, so don't get me wrong. I have a hard time actually wanting to own the company, but yeah, we'll see how the day goes. But I think really, if we get a good, decent CPI report, the next 2 reports, that's when we could maybe really start seeing some actual Fed cuts realistically priced in. Right now, it still seems like impossible, especially with these wage numbers, stable on the wage numbers, but slightly inflationary. That's going to be it's going to be a while before we see any kind of cuts. It's all going to come down to those CPI reports. So we'll see. Anyway, otherwise, we'll wait until then. I'll keep drinking coffee, and I'll see you in the course member live stream soon. Thanks so much for being here, and we'll see you soon.